There's been a major sell-off in tech stocks recently, and it's got a lot of investors on edge. The Nasdaq dropped more than 2% in a single day. A big move for a sector that's been powering the market for years. But according to top Wall Street analyst Dan Ives, this isn't the time to panic. It's actually the time to buy. He says the sell-off is being driven by fear, not fundamentals. And when you look under the hood at what's really happening with demand, innovation and long-term trends, you start to see a totally different picture. Let's start with Asia. Right now, demand for NVIDIA's Blackwell AI chips is outpacing supply by 15-1. Just a few months ago, that ratio was 12-1, so demand is accelerating, not slowing down. That doesn't sound like a tech bubble bursting. That sounds like a revolution still picking up steam. The bigger story here is that some of the most important, most disruptive companies in AI and next-gen tech are on sale. And if you believe in the long-term growth of artificial intelligence, robotics, cloud computing and automation, this could be one of the best buying opportunities we've seen in years. So let's break down 3 companies Dan Ives says are must-own stocks for the next decade. NVIDIA, the engine behind AI. NVIDIA isn't just another chip maker. It's the infrastructure powering the AI world. Every major breakthrough in AI, from ChatGPT to self-driving cars to generative design and robotics, runs on NVIDIA's hardware. And now they're going even further. At their most recent GTC conference, NVIDIA introduced something called Isaac GR0000TN1, an open-source foundation model built specifically for humanoid robots. That might sound futuristic, but the market for AI robotics is expected to hit $77 billion by 2032. And NVIDIA wants to own it. Meanwhile, their new Blackwell Ultra chips offer double the bandwidth and more memory, which is exactly what companies need as AI workloads explode. Demand for these chips is overwhelming. In Asia alone, it's outstripping supply by a 15-1 ratio. And yet, after this massive product showcase, NVIDIA's stock dropped. Why? Short-term fear, macro noise, investors focused on short-term volatility instead of the long-term opportunity. Dan Ives sees NVIDIA as a $4 to $5 trillion company in the making. If he's right, this pullback might be one of the best chances to get in before the next leg up. Amazon, the robotics giant nobody's talking about. Amazon is best known for online shopping, but behind the scenes, it's building something even bigger. An advanced ecosystem of robots, AI, and cloud services that could reshape global logistics and automation. Amazon started its robotics journey back in 2012 when it bought Kiva Systems. Since then, they've scaled up massively. Today, Amazon has over 750,000 robots deployed in its warehouses, and that number has doubled in just 3 years. These robots are driving real results: faster shipping, lower costs, and higher profits. In fact, Amazon's margins jumped from 2% in 2022 to over 11% in 2024. That's a huge shift. But here's the kicker. Amazon isn't just using robots internally, it's turning them into a product. Just like AWS changed the world of cloud computing, Amazon is now offering tools like RoboMaker and RoboRunner, helping other companies build and manage their own robots, all through Amazon's infrastructure. The industrial robotic market is projected to hit $60.5 billion by 2032. Amazon wants to be the cloud backbone of that transformation. Despite all this, the stock has pulled back 20% from its highs. Wall Street is focused on short-term headwinds and missing the bigger story. Amazon sits at the crossroads of e-commerce, AI, cloud, and robotics. No other company has that mix. That makes this dip a buying opportunity for long-term thinkers. Alphabet, or Google, is reinventing itself in real time. Let's talk about Google. Lately, there's been a lot of noise about how AI might hurt Google's core search business. Tools like ChatGPT, Microsoft's Copilot, and Perplexity AI are gaining traction. For the first time since 2015, Google's search market share dropped below 90%. Sounds scary, right? But here's the thing. Google still holds 74% of global search. That's a massive lead. And their ad business, which powers their revenue, is still growing. The digital ad market is expected to expand at over 15% annually through 2030. And guess who dominates that market? Google. Plus, they're not sitting still. Google Cloud is growing 25% year over year. Their new Gemini AI model is being rolled out across Android, Google Search, and their cloud products. And Google still has one of the biggest advantages in AI data, scale, and infrastructure. Even in a worst-case scenario, Alphabet is fairly valued at around $1.9 trillion. But if they keep growing their services business by just 12% a year, the company could be worth $3.25 trillion, a 61% upside from where it is now. Dan Ives says investors are looking at the wrong things. Google isn't falling behind, it's evolving. Final take. Here's the big idea. This tech sell-off isn't a sign of weakness. It's a chance. We're talking about companies that are leading the most important shifts in technology: AI, robotics, cloud computing, and automation. And right now, the market is giving you a shot to buy them at a discount. Historically, these are the moments where smart investors build positions, not walk away. Our past picks have yielded great results. IonQ at $10, now over $40. QBT went from $2.50 to $27 in just 2 months. Apluvin rocketed from $75 to $400. MicroStrategy from $130 to over $500. These weren't flukes, they were opportunities spotted early, and our next one, it's already in play. Thanks for watching. If you found this video helpful, give it a like, drop a comment with your thoughts or questions, and subscribe to the channel so you don't miss future breakdowns like this. We've got more deep dives coming on AI, disruptive tech, and smart investing plays. Let's ride the next wave together. See you in the next one.